Have you noticed how strange everything feels right now? Like the storm already passed and we're all just getting back to normal life. Jobs, markets, politics, pretending everything's fine. But it's not fine. It's too quiet. And if you've lived long enough, you know that kind of silence only shows up before something big hits. Look at the numbers. For the first time since 1933, during the Great Depression, the US money supply, the actual amount of dollars circulating in the economy, is shrinking. Every single time that's happened in history, a major crash followed within a year. That's a historical pattern. In the 1980s, it meant Black Monday. In the late 2000s, when liquidity vanished overnight, it meant the Great Recession. And today it's happening again, while everyone's distracted by record stock prices. But this time it feels different, doesn't it? The economy looks fine on paper, but the signs don't match the story. Groceries are still expensive, rents are still rising, people are working harder, saving less, and somehow getting poorer. It doesn't make sense until you realize the system itself is running on fumes. We're told inflation is under control. We're told the recovery is real. But if things are so strong, why does the Federal Reserve still hold close to $7 trillion on its balance sheet, even after years of tightening? And why are central banks around the world buying record amounts of gold? The truth is, the calm you're feeling isn't stability, it's paralysis. The system's frozen between inflation that's still burning and a market that can't afford higher rates. And when both fire and ice exist at the same time, something has to give. In this video, I'm going to break down exactly what that something is. We'll connect every piece, from how the last 15 years of cheap money built this fragile economy, to why debt no longer fuels growth, to how central banks are trapped in a corner with no safe move left. You'll see the signs already flashing in the data, the global shift that's underway right now, and most importantly, what it means for you and how to stay one step ahead when the next stage hits. But to do that, you need to understand how we got here. You have to look at what built this illusion in the first place. To understand the stage we're in now, you've got to rewind a bit, not to 2008, but to what came after it. Because the truth is, the seeds of this crisis weren't planted by the crash, they were planted by the rescue. When the financial system collapsed in 2008, the world's answer was simple: print, borrow, and bail out. The Federal Reserve expanded its balance sheet from under $900 billion before the crash to about $4.5 trillion by 2018, a five-fold increase in just 10 years. But it wasn't just the printing. For more than a decade, the Fed kept interest rates near zero, making borrowing almost free. That was supposed to be a one-time emergency measure, a temporary fix to save the system. But instead, it became the system. Because when markets realized the Fed would step in every time things got shaky, risk stopped meaning anything. Borrowing got cheaper, speculation got safer, and the entire economy learned one lesson: if something breaks, the central bank will print. Then 2020 hit, and they did it again, only bigger. COVID froze the world overnight, and in a matter of months, the Fed printed more money than it had during the entire decade after 2008. The balance sheet shot from around $4 trillion to nearly $9 trillion, flooding the system with cheap liquidity all over again. Zero interest rates returned, stimulus checks went out, markets roared back like nothing happened, and for a moment, it felt like the system was unbreakable. It was the biggest stimulus experiment in human history. People got checks, companies got bailouts, markets got addicted. And what did we get in return? Inflation, the kind we were told could never happen again. Prices surged, wages couldn't keep up, and suddenly the system that thrived on easy money hit its limit. Because inflation is like a mirror. It reflects all the lies we told ourselves about growth. Here's where it gets dangerous. When inflation took off, the same central banks that caused it had to slam the brakes with the fastest rate hikes in 40 years. The system that was built for 0% interest wasn't designed for 5%. And just like that, all the debt that felt safe, mortgages, corporate loans, government bonds, started cracking under the pressure. The irony is that every solution since 2008 has only made the system weaker. We solved debt with more debt, inflation with more printing, stagnation with more stimulus. Each fix made the next problem bigger. Think about it like this. The global economy is a bridge. After 2008, we patched its cracks with paper and glue, easy money, and optimism. It held for a while. But now the weight of all those promises is bending the beams. You can't patch it anymore. You have to rebuild it. And that's exactly what this final stage is, the moment the patches start to tear. So if everything looks okay on the surface, markets calm, headlines confident, remember this: stability built on leverage isn't stability. It's balanced on a knife's edge, and that edge is starting to shake. If you want to know where the next collapse begins, don't look at the headlines. Look at the data no one talks about. Because it's not the big explosions that give it away, it's the slow creaks before the break. And right now those creaks are everywhere. Start with households. American families now owe more than $18.39 trillion in total debt, the highest number in history. Credit card balances alone just crossed $1.2 trillion, and delinquencies are rising faster than they did before the 2008 crash. Savings are practically gone. The average savings rate has fallen to 5.3%. That means millions of people are now surviving paycheck to paycheck, borrowing just to stay afloat. And that's not a healthy economy. That's a lifeboat taking on water. But it's not just consumers. The housing market, once the symbol of wealth, is starting to fracture again. Mortgage rates are hovering around 7%, making home ownership the least affordable it's been in over 40 years. And it's not just residential. Commercial real estate is collapsing under its own weight. Banks are sitting on billions in bad loans tied to those buildings, pretending the losses don't exist. Sound familiar? It's the same denial that defined 2008, except this time the exposure is even larger. Meanwhile, Wall Street is still celebrating. The S&P 500 is near record highs, fueled not by real growth, but by corporate stock buybacks, over $1 trillion this year alone. Think about that. Companies aren't investing in innovation or productivity, they're buying their own shares to keep prices inflated. That's not a strength, that's stage makeup on a corpse. And behind those glossy charts, corporate earnings are stagnating. Small businesses are closing at the fastest pace since 2010. Consumer spending is flat, adjusted for inflation. Everywhere you look, the same contradiction repeats: surface-level optimism, structural decay. People say, the economy's resilient, but resilience means you can take a hit and bounce back. This system doesn't bounce anymore. It absorbs pain by adding more debt. And that's not resilience, that's decay disguised as recovery. Because right now the signs are clear. Debt is climbing, savings are vanishing, real wages are falling, and the markets are pretending none of it matters. But it does. It matters because this is the stage right before reality catches up, when data starts pointing to a disaster that headlines won't admit. These aren't random cracks, they're pressure points. And if you line them up, they all lead back to the same cause: a system that's addicted to cheap money and running out of its next fix. And that addiction is about to hit withdrawal. There's a pattern in every financial crisis, one that's easy to miss because it always hides behind numbers. But once you see it, you can't unsee it. It's simple. We built an economy that only grows if debt grows faster, and now that equation doesn't work anymore. Here's what I mean. Between 2010 to 2020, every dollar of economic growth required about 40 to 60 cents in new debt. By 2025, that number has passed $1.2. That means we now have to borrow more than $1 just to create $1 of growth. Governments, corporations, consumers, everyone's doing the same thing. We've created a world economy that's $105 to $110 trillion in annual output, sitting on top of $315 trillion in global debt. That's nearly $3 of debt for every $1 of production. And no, that doesn't mean collapse tomorrow, but it means the system now needs constant new borrowing just to stay alive. It's like a patient who can't breathe without oxygen, except the oxygen is debt and the tank's running out. At first, debt feels good. It boosts spending, inflates assets, makes everyone feel wealthier. But each new dollar of debt now buys less and less real growth. It's not a strategy anymore. It's an addiction. Nearly 1 in 5 large companies is now what economists call zombies, businesses that can't cover interest payments without borrowing more. And when rates rise, the drug stops working. The Fed's benchmark rate sits above 5%, the highest in over 2 decades. Suddenly, the interest bill on all that cheap money has come due. Governments are paying record amounts just to service debt. Corporations are cutting costs to stay afloat. Consumers are maxing out credit cards just to survive inflation. It's the same crisis, repeating at every level. The more we borrow to keep the system alive, the more inflation we create. Then to fight that inflation, central banks raise rates, which makes the debt harder to repay. Debt feeds inflation, inflation feeds more debt. A spiral with no exit. And the worst part? It's not accidental. Policymakers knew this couldn't last, but when your economy depends on endless borrowing, later always wins over never. Now every solution breaks something else. Cut rates, inflation returns. Raise them, the system cracks. Print more, trust collapses. There's no way out, only the inevitable correction. We like to think the people running the system know what they're doing, that there's a plan behind every headline and press conference. But there isn't. The people at the controls, the central banks, are trapped. For years, they kept the economy alive by printing money and holding interest rates near zero. It worked until inflation exploded, and the only tool left to fight it is the same one that breaks the system they built. The Fed can't raise rates without breaking something, but it can't cut them without reigniting inflation. That's the trap. Raise rates and the debt implodes. Cut them and the currency does. This isn't just an American problem. Europe, Japan, Canada, they're all stuck in the same box. Debt loads are so massive that even a tiny rate hike adds billions in new interest costs. The US government now pays over $1 trillion a year just on interest, more than it spends on defense. Meanwhile, the yield curve is more inverted than at any time since 1981, and every time that's happened in the past 50 years, a recession followed. Yet markets keep celebrating. Stocks rise, headlines cheer soft landing. But behind the optimism, the bond market is flashing red. Investors know the math. The system can't survive high debt and high rates. So central banks are improvising. Publicly, they promise discipline. Privately, they're already injecting liquidity, backstopping markets, and hoping it holds. They're not managing the economy anymore. They're managing perception, because the moment people stop believing, the illusion collapses. And that's the real danger. The plane's still in the air, but the engines are already on fire. Every empire believes its money will last forever. The British believed it about the pound, the Romans the denarius. For 80 years, the world believed it about the US dollar. But history has a pattern, and it's repeating. The dollar's dominance isn't collapsing overnight. It's eroding slowly, trade by trade, deal by deal. In 2000, 72% of global reserves were held in US dollars. Today, it's just 58% and falling. Over 40% of global trade now settles in other currencies. China and Saudi Arabia trade oil in yuan. India and Brazil settle in local currencies. The BRICS nations are building a new system backed by commodities, not US debt. This isn't rebellion, it's risk management. After decades of US sanctions, money printing, and debt, nations realized if your wealth is in dollars, it's not really yours. Central banks have responded by buying over 1,200 tons of gold in just 18 months, the largest surge in history. Gold doesn't need permission. It can't be frozen or inflated away. The world is slowly building a new financial backbone, not in Washington, but across multiple currencies, metals, and systems. This isn't the end of money, it's the migration of trust, from paper dollar promises to real value. And as nations prepare, ordinary people will feel the shift first. You can talk about trillions and policies all day, but if you want to know how an economy's really doing, look at the people living in it. Real wages haven't kept up with inflation. In fact, inflation-adjusted pay has barely grown since 2020, and in some measures it has fallen. Meanwhile, the cost of living keeps climbing. Your dollar lost nearly a fifth of its value in 5 years. Rates rise, loans dry up, jobs disappear, and the cycle feeds itself. Half of US households now carry more credit card debt than savings. Politicians call it resilience, but behind the numbers are families juggling bills, working multiple jobs, and wondering why the math no longer works. Every major collapse in history has one thing in common. It never starts with markets or money. It starts when people stop believing. Because money itself is just a belief, collective trust and a promise. And right now that trust is cracking. When people stop trusting institutions, they stop believing in the story that built modern life, that hard work pays off, that savings are safe, that the system protects you. Now those stories are collapsing. People don't plan for the future. They try to survive the present. And once trust breaks, everything built on it, money, markets, politics starts to shake. And that loss of trust always leads to the same place, a market collapse. It happened in 1929 when overconfidence and endless growth turned to panic overnight. It happened in 1973 when inflation and energy shocks shattered faith in money itself. It happened again in 2008 when the promise that banks are safe vanished in a single weekend. Here's the truth: the collapse of a system doesn't mean the collapse of everything, it means transformation. And in every transformation, there are two kinds of people: those who panic and those who prepare. History doesn't punish the people who see change coming. It punishes the ones who ignore it, who convince themselves that this time it'll be different. But if you've made it this far in the video, that's not you. You already know something's off. You felt it in your wallet, in your job, in the way the world suddenly feels uncertain in ways it didn't before. That's your advantage. Because while the majority are still waiting for someone to tell them what's happening, you're already watching it unfold in real time. And that means you have time, not to stop it, but to position yourself for what comes next. When trust collapses, values shift, and those who understand the shift first build the next system. That's how every major cycle works. The Great Depression built new industries. The 1970s inflation birthed new financial systems. The 2008 crash gave rise to a digital economy and new technologies like crypto and decentralized finance. Every ending creates a beginning, but only for those who are paying attention. The next cycle won't belong to governments. It'll belong to creators, investors, and problem solvers who can think independently and move faster than the institutions collapsing around them. So here's how you stay ahead. Learn, because understanding what's breaking lets you see what will rise next. Diversify, not just your money but your skills, income, and networks. Own something real: assets, businesses, knowledge, things no policy can print. Information is the new currency. So use what you know, not to fear the change but to leverage it, because every collapse ends the same way, with a transfer of money, of power, of opportunity. That's why I built this channel, to make sense of the chaos, to connect the dots that the headlines won't, and to help people see what's actually happening before it hits. So if you want to stay ahead of the curve, understand the real shifts in money, power, and opportunity, subscribe to the channel right now.